Welcome to Global Economics and Finance, your guide to understanding how the world really works. Across the last 100 years, banking crises have defined economies, destroyed wealth, and reshaped nations. Today, we trace the pattern and what it means for the future.
Right, so I want you to picture a scene. It's the year 1930. The air is just thick with panic. Right?
Oh yeah, absolute chaos.
Exactly. And you have been standing in this physical line for like 2 straight days. It's wrapping around some grand marble columned bank building, and you are just hoping to withdraw your life savings before the vault literally runs dry.
And you're moving at a crawl, completely at the mercy of how fast the teller can actually count the paper bills.
Right. Now, I want you to smash cut to the year 2023. There are no lines. There is no physical cash to hold. There is just this viral social media panic, a few anxious taps on a smartphone screen, and boom, $10 million is withdrawn from a bank every single second.
It is a staggering contrast. I mean, this is wild. We've gone from bank runs that move at the speed of, a physical shuffling cue to panics that execute at the speed of a retweet.
Yeah, and that massive shift in velocity is exactly what we are unpacking today. Because for this deep dive, we've got our hand on a really fascinating, highly structured presentation deck. It's called Century of Financial Fragility.
Which is a great title, by the way.
It really is, and we're looking at that alongside a deeply researched background document. Together, these sources detail over 150 systemic banking crises spanning exactly 100 years. So from 1926 to 2026. So let's just jump right in. Let's start with the psychology of it all. Because to understand why banks fail today, we actually have to understand the psychological trap that sets up, almost every single crisis.
Yeah, the research calls it the lull illusion.
The lull illusion. But before we get to the illusion part, let's establish that 100-year timeline. The data points to this repeating tight, loose, tight regulatory cycle. What does that actually look like historically?
So we see this pattern constantly. If you look at the 1920s, with events like the Shucho financial crisis in Japan, that was 1927, and then the catastrophic Great Depression globally in the 1930s, the system experienced mass solvency collapse.
Just total failure across the board.
Exactly. And the rigid gold standard, which tied a currency's value directly to physical gold, actually made things significantly worse.
Wait, really? Because you always hear people saying we should go back to the gold standard to make things safer.
I know, but mathematically it was a trap during a panic. Because central banks couldn't just print money to inject liquidity, they were constrained by the actual physical gold they had in the vault. So the only way to stop the bleeding was to declare mandatory bank holidays.
Which means just literally shutting the doors to stop people from taking their money.
Right. Shutting the doors to stop the panic and eventually abandoning that gold standard entirely.
So the system completely breaks down, and the reaction is that regulation gets incredibly tight. I mean, in the US, they passed the Glass-Steagall Act in 1933. Let's pause here for a second, because this is an explainer moment. For someone who isn't a financial historian, what did Glass-Steagall actually do?
Think of it as a structural firewall. It legally separated commercial banking from investment banking.
Okay, so breaking that down.
Yeah, meaning the bank that holds your everyday checking account and, makes safe mortgage loans was no longer allowed to take your deposits and gamble them on high-risk Wall Street trading.
Got it. So my boring checking account is safe from the Wall Street guys.
Exactly. And that structural firewall ushers in what the deck calls the most stable era in the last century. That's the Bretton Woods era, running from roughly 1946 to 1970.
So what made that specific window so stable?
Well, during that window, we had a global agreement fixing major currencies to the US dollar and the dollar to gold. Capital movement across borders was heavily restricted and managed. It was a highly stable, tightly controlled regulatory regime.
But, and here's where things get crazy, that very stability is what breeds the vulnerability.
Paradoxically, yes, absolutely.
Which brings us back to the low illusion. It's like, okay, think of it like living in a city that hasn't had an earthquake in 50 years. Eventually, city planners and developers just, they stop building earthquake-proof houses.
That is a perfect analogy.
They look around and think, well, the ground hasn't shaken in my lifetime, so we must have conquered earthquakes. Let's build glass skyscrapers. And you see this explicitly in the 2003 to 2007 period, just a multi-year stretch of massive profitability and low volatility.
Yeah, and that false comfort creates a very dangerous "this time is different" syndrome.
Yeah.
Policymakers and bankers start to believe that modern financial innovation has permanently engineered risk out of the system. So regulations are relaxed, the tight cycle transitions back to loose.
I am struggling with this lull illusion idea, though. I mean, play devil's advocate with me here. If I'm a bank CEO today, I literally have supercomputers, right? I have algorithmic trading models and AI stress testing my portfolio millions of times a day.
Sure.
You are telling me a century of massive technological advancement and data collection hasn't made these banks fundamentally safer? Like, why do we keep falling into the exact same trap?
That's a great question. But the reality is, algorithms can only process the parameters we give them. And they absolutely cannot code out human nature. Greed, fear, how human beings react to sudden shifts in inflation, those drivers remain identical to the 1930s.
So the tech doesn't fix the human flaw.
If anything, what technology actually does is accelerate the innovation of risk. Wall Street consistently invents new ways to hide risk faster than regulators can figure out how to measure it. Take the 2008 crisis, for example.
Well, yeah, the subprime mortgage mess.
Right. We saw massive growth in shadow banking, which is basically complex lending and trading that happens outside the traditional regulated banking system. We also saw securitization, where thousands of risky mortgages were bundled together and stamped with a safe label.
So the supercomputers looked at those bundles and said, yep, looks safe to me.
Exactly. The math looked flawless to the computers. But the underlying human behavior, giving mortgages to people who couldn't pay them back, was incredibly reckless.
Okay, so the lull illusion essentially blinds the regulators. Everyone feels incredibly safe, but vulnerabilities are secretly building up in the architectural background. That leads us to the mechanical engines of collapse.
Yes, the core mechanisms.
Our sources map out what they call the 4 engines of systemic failure. And rather than just, listing them like a textbook, let's really break down how they function.
Let's do it. These are the underlying causal mechanisms that break the system when the illusion of safety shatters. First, we have asset quality.
Which means what, exactly?
In simple terms, this is speculative lending.
Right.
It's a bank pouring money into non-productive assets, basically just hoping the price keeps going up. We saw this with the massive commercial real estate bubbles during the U.S. savings and loan crisis of the 1980s.
Right. Then there's engine number 2, maturity mismatch. This one is huge.
Oh, it's the classic killer of banks.
It basically means borrowing short to lend long. So a bank takes in deposits that customers can withdraw tomorrow, but uses that money to buy investments that don't pay out for 10 or 30 years.
Spot on. Then the third engine is governance. This often manifests as heavy state interference or crony capitalism.
Let's make that concrete for people listening. What does a governance failure actually look like on a bank's balance sheet?
Okay, picture this. It looks like a bank president approving a massive zero-interest loan to his brother-in-law to build a luxury resort, right? But the resort has no actual customers.
What?
He only gets the loan simply because they have political connections.
Yeah.
The loan is practically guaranteed to default, but the bank's books pretend it's a performing asset until the very last second.
That is wild. And engine number 4?
The fourth engine is macro shocks. So sudden, violent spikes in inflation or unexpected geopolitical conflicts that just completely upend the broader economy.
All right, so let's see these engines in action with a real-world case study from the data. The 1997 Asian financial crisis is highlighted in the deck as the ultimate example of the domino effect. But, let's break this down. How does a localized issue in Thailand suddenly wipe out a bank account in Brazil?
It's a chain reaction and starts with an engine failure. In Asian countries during the 1990s, there were massive credit booms that vastly exceeded real economic growth. Money was flowing to well-connected corporate insiders.
Ah, so there is your governance failure, the brother-in-law resort.
Exactly. And all of this was propped up by fragile currency pegs. Countries like Thailand legally tied the value of the Thai baht to the US dollar to attract foreign investment.
And the trigger point was when Thailand essentially ran out of foreign reserves trying to defend that peg against speculators. They just couldn't maintain that artificial exchange rate anymore.
Right. They fought it until they had nothing left. And when they finally let the brat float freely on the market, its value absolutely plummeted. And here is where the global contagion channels take over.
This is the domino effect.
Global investors watched Thailand fall and suddenly realized, uh-oh, neighboring countries like Indonesia, Malaysia, and South Korea have the exact same structural vulnerabilities, the same crony loans, the same currency pegs.
So it was a massive shift in shared investor perception. They woke up and realized the whole region was built on the same shaky foundation.
Yes. The hot money, which is that short-term foreign investment constantly chasing high returns, just fled the entire region instantaneously.
The statistics from this in our research are honestly devastating. Listen to this. The Indonesian rupiah lost 81% of its value against the dollar in just 6 months.
Let that sink in. 81%.
The purchasing power of an entire nation was just obliterated. And it didn't stop in Asia. That shared panic spread to Russia, contributing to a massive sovereign default in 1998, and then the shockwave hit Brazil.
It's terrifying to trace that line.
Yeah.
And just to put the sheer cost of these failures into perspective, the data logs 151 systemic crises since 1970 alone.
Yeah, and the human cost is massive. In the 1990s, the country of Bulgaria lost 42% of its entire GDP just trying to resolve its banking crisis.
Like 2% of their GDP.
Yeah.
Which perfectly illustrates the stakes here. A banking failure isn't just numbers moving on a Bloomberg terminal. It is the instantaneous evaporation of national wealth. It shows how premature financial liberalization, like opening up your markets without having strong institutional safeguards in place, acts like pouring gasoline on a localized fire.
Okay, so we have established the historical baseline, we've mapped the disease, but as we move into the modern era, specifically that 2023 to 2026 window, those 4 engines of collapse are identical. The greed, the maturity mismatch, it's all still there.
It hasn't changed a bit.
But the speed of contagion has fundamentally mutated. We have transitioned from the physical dominoes of the 20th century to instantaneous digital algorithms.
Yeah, the research refers to this as digital velocity.
This is where the math of the digital era gets terrifying. Because in the global financial crisis of 2008, hundreds of banks failed. But in 2023, just 5 U.S. bank failures wiped out $548 billion in assets.
It's an unbelievable concentration of failures.
Silicon Valley Bank alone lost $42 billion in just 4 hours. That is where we get that figure from the intro $10 million withdrawn every single second.
The presentation deck visualizes this modern vulnerability as the geometry of disaster.
Sure.
It's a triangle of forces.
We'll walk through the triangle.
Force 1 is uninsured digital deposits. That acts as the funding base. Force 2 is sudden interest rate hikes, acting as the macro shock. And Force 3 is long-term bonds losing value, which acts as the compromised assets.
Now pause right here, because here's the twist, and this part will actually blow your mind. It is the most tragic irony of the modern crisis. In 2008, banks failed because they bought toxic, garbage subprime mortgages that were fundamentally worthless.
Right, they were buying bad assets.
But in 2023, these banks failed because they bought the safest, most reliable assets in the world. U.S. Treasury bonds.
Which is so counterintuitive.
It really is. It is like locking your money inside a high-tech time delay safe. The money is absolutely secure and no one can steal it. But if your house catches on fire today and you need the cash immediately to escape, you are completely out of luck. The safe won't open.
That analogy perfectly captures the mechanics of maturity mismatch in the modern era. Let's look at Silicon Valley Bank as the prime example. During the tech boom, banks took in billions of dollars in deposits from startups.
It's just a flood of cash.
And these were uninsured deposits because a tech company's payroll account holds tens of millions of dollars, which is way above the $250,000 FDIC insurance limit. So the bank took that massive pile of cash and bought 10-year U.S. Treasury bonds paying roughly 1.5% interest.
Okay, so far so good.
Now, if you hold a Treasury bond to maturity, it was risk-free. The U.S. government will pay you back.
Yeah.
But there is a fundamental law of gravity in finance. When central banks raise interest rates, the market value of existing, older bonds goes down.
Let's clarify why that happens for everyone listening. If I hold an old bond paying 1.5% and the Federal Reserve aggressively raises rates to fight inflation so that brand new bonds are suddenly paying 5%, well, no investor on earth wants my old bond.
Exactly. Why would they take 1.5 when they can get 5?
Right. So if I need to sell it today, I have to sell it at a massive discount just to get someone to take it off my hand.
And that discount is called a mark-to-market loss. As long as nobody asks for their deposited money back,
Right.
It's just a loss on paper. The bank can just wait it out. They can sit on the bonds until maturity.
Okay.
But when a Twitter-fueled panic starts in the venture capital community and dozens of tech founders click withdraw on their banking apps simultaneously, the bank doesn't have the physical cash on hand.
They need cash immediately, but it's locked in the time delay safe.
Right. So they are forced to sell those safe 1.5% bonds into a 5% market, taking a massive realized loss. Their entire capital buffer is erased in hours. The liquidity vanishes.
So the low inflation lull tricked them into locking their money in that safe, and the sudden shift to a high inflation regime lit the house on fire.
Beautifully put. And it also highlighted a massive regulatory blind spot because around 2019, Regulators introduced these tailoring rules, which basically exempted mid-sized banks from the strictest liquidity standards and stress tests.
Because the assumption was what? That a bank with $100 billion or $200 billion in assets wasn't systemically dangerous to the whole country?
Exactly, because they weren't the trillion-dollar global titans like JP Morgan. But $500 billion wiped out in a single year proves that in the digital age, mid-size is plenty big enough to cause a massive systemic shock.
I mean, if a mid-sized bank in California can collapse in an afternoon just from an interest rate hike, what happens to a bank in a developing country when a literal conflict breaks out next door?
The vulnerabilities get so much worse.
Let's look at the global map, because the background document provides a fascinating tour of regional vulnerabilities. It shows how different parts of the world fall prey to different engines of failure. Let's start with Latin America.
Latin America is famous for the lost decade of the 1980s. They experienced what's called a triple crisis. They suffered sovereign debt, currency, and banking crises all simultaneously.
How does that even happen all at once?
It happened because they had borrowed heavily in U.S. dollars. When the U.S. hiked rates aggressively to fight its own inflation, the value of the dollar skyrocketed. That made Latin America's foreign debt mathematically impossible to repay.
A macro shock triggering a currency and debt collapse. Moving across the globe, you have sub-Saharan Africa, where the data points to endemic crises deeply linked to heavy government intervention and state-directed lending.
That is your classic governance failure, the state forcing banks to make bad loans.
Right. By contrast, South Asia historically showed resilience. India managed to avoid the worst of the 1997 Asian contagion, largely due to strict capital controls that prevented that hot money from fleeing.
But the map shifts rapidly as we look at the 2025 and 2026 data. Pakistan, for instance, was recently reclassified by the World Bank into the MENAP risk group, which stands for Middle East, North Africa, Afghanistan, and Pakistan.
Okay, so their economic fate is no longer viewed alongside the high-growth story of South Asia. Now it is tied to the volatility of the Middle East. And the geopolitical shocks documented in 2026 are severe. The research cites the Pahalgam crisis between India and Pakistan, as well as the 2026 Middle East conflict.
Which forces us to examine exactly how global macro shocks transmit through the system today.
And I want to pause here and make something very clear for the listener. It's incredibly important to look at events like the Pahalgam crisis or the 2026 Middle East conflict strictly through the lens of global finance. This deep dive takes absolutely no political sides. Capital doesn't care about politics, it cares about friction, supply chains, and risk.
Absolutely. We are just looking at the math of contagion.
Exactly. So mathematically, how does a border dispute or a regional conflict in the Middle East squeeze a local commercial bank in Senegal? Because the data notes that this specific conflict cost the African continent 0.2% in economic growth. That's a massive hit.
It comes down to something called the sovereign bank nexus. It is an incredibly dangerous dynamic, and economists often refer to it as the doom loop.
The doom loop, that sounds encouraging.
Oh, it's terrifying. In many developing and emerging markets, the domestic commercial banks hold massive amounts of their own government's sovereign debt. They buy government bonds because regulators treat them as risk-free capital.
So the local bank is basically acting as the government's biggest credit card.
Yes. Now, consider the macro shock. If a regional conflict breaks out, global energy and fertilizer prices often skyrocket due to supply chain disruptions. That developing government suddenly has to spend vastly more money just to subsidize basic food and fuel to keep its economy running.
Because they have to keep the lights on and feed their people.
Right. So its fiscal deficit explodes. International investors see the strain and demand higher yields, causing the market value of that government's sovereign debt to drop.
And because the local banks are the ones holding all that government debt as their core assets, their balance sheets suddenly look completely insolvent.
Exactly. The country struggles economically, and the banks are dragged down with it. It becomes a vicious, self-reinforcing loop. The bank is taking massive losses on the government bonds, so it stops lending to local businesses.
Oh, I see where this goes.
Yeah, without credit, local businesses fail, the economy slows down further, and the government collects less tax revenue. With less tax revenue, the government's debt becomes even riskier, its bond prices fall further, and the bank takes another massive hit to its capital.
It is a literal doom loop. You cannot stabilize the bank without stabilizing the government, and you cannot fund the government without a stable bank.
It's the ultimate trap.
Okay, so we have mapped the disease pretty thoroughly here. We've looked at the repeating 100-year cycle, the psychological trap of the lull illusion, the 4 engines of collapse, the terrifying velocity of digital panics. and the geographic contagion of the doom loop. Now, we need to extract the cure.
The good news is there is one.
The presentation deck concludes with a blueprint for resilience. What does that look like?
What is fascinating about this blueprint is that it does not call for inventing magical new financial instruments. It is entirely about returning to fundamental architecture. It outlines key principles that regulators and banks must adopt.
Let's hit the major ones. Number 1, loss-absorbing capital. That's the ultimate buffer against a panic, right?
There is absolutely no substitute for high-quality capital. History proves time and time again that banks with higher capital ratios consistently survive systemic shocks. If the bank's owners and shareholders have enough of their own money on the line to absorb losses, a temporary drop in bond prices doesn't instantly render the institution insolvent.
It buys them time.
Precisely.
Number 2 is proportional regulation, which is a direct lesson learned the hard way in 2023. You cannot create regulatory blind spots by exempting mid-sized banks from stress tests just because they aren't global titans.
Right. If an institution can lose $40 billion in an afternoon and panic the entire tech sector, it requires strict, unyielding oversight, period.
Okay, what else is in the blueprint?
Another critical pillar is preemptive inflation management. The dataset clearly shows that the transition from a low inflation lull into a high inflation regime and the aggressive central bank interest rate hikes that inevitably follow is the single most common trigger for banking insolvency.
So central banks have to act proactively to anchor inflation expectations long before a wage price spiral actually entrenches itself in the economy.
Exactly. You put out the sparks before the house is ablaze.
So the overarching theme here is moving away from reactive firefighting. Since 2008, I think the public has grown incredibly exhausted by the too big to fail doctrine.
Oh, without a doubt.
Where the system breaks and the government just steps in with a massive taxpayer bailout. Bailouts create moral hazard. They essentially tell bankers, hey, you can take wild systemic risks to boost your bonuses, and if it blows up, someone else will pay the bill. The deck contrasts that directly with proactive resilience.
And the strategic insight there is that we must delink the vertices of that disaster triangle we talked about earlier. We need a system where a sudden shock in interest rates doesn't automatically trigger a digital panic that drains funding. And one of the most effective ways to achieve that delinking is the principle of radical transparency.
Radical transparency, I like the sound of that. But what does it actually look like in practice? Like, when you and I check our banking apps, what should be different?
It means mandatory, clear, and comprehensive public disclosure of risk exposures. You shouldn't need to hire a forensic accountant to read the footnotes of a quarterly earnings report just to figure out if your bank is sitting on billions in mark-to-market bond losses.
It should be right there in plain sight.
Exactly. Crises are consistently worsened by an information vacuum. If the market, the depositors, and the regulators can clearly see the capital buffers and the true asset quality in real time, risk gets priced in gradually. Depositors adjust their behavior slowly, rather than everything culminating in a sudden, catastrophic panic when a rumor hits social media.
I love the core philosophy the authors highlight for the century ahead. They write, technology changes speed, fundamentals decide outcomes.
It is the perfect synthesis of all this data. I mean, the physical leather-bound ledger book of the 1930s and the biometric smartphone app of the 2020s, they are just tools. But liquidity, robust capital buffers, and institutional independence.
Meaning protecting bank regulators from political interference.
Right. Those are the underlying fundamentals that determine whether a society's wealth grows steadily or vanishes overnight.
It really has been an incredible journey through a century of data today. We started with physical crowds of people in fedoras standing in the rain in 1930, terrified that the bank vault was literally empty.
Yeah.
And we've ended up in the 2020s, where an algorithmic, Twitter-fueled panic can drain $10 million a second. The speed has changed entirely, but the root causes, the greed, the illusion of stability, the mismatch of borrowing short to lend long, those are eternal.
They are. But if we look to the horizon, synthesizing all this historical data leaves us with a rather chilling thought to consider about the future.
Oh, I know exactly where you're going with this.
If technology has reduced the time it takes to completely drain a major bank from several days in the 1930s to a matter of hours in 2023, well, what happens in the near future?
Right.
What happens when AI and sophisticated algorithmic trading models are deeply integrated into corporate treasury departments? If an AI model detects an impending interest rate shock or, say, a geopolitical supply chain issue in the Middle East, it could automatically trigger a massive coordinated bank run in milliseconds.
Oh, wow.
A total capital flight executed before human regulators even have time to wake up and pour their morning coffee.
A completely automated, superhuman bank run. That is a terrifying and absolutely fascinating thought to chew on. And it is a perfect reason for everyone listening to take a much closer look at the quote-unquote safe institutions currently holding your money. If you enjoyed unpacking this massive century of financial data with us, don't forget to subscribe to the feed, drop a comment with your thoughts on how you are navigating the digital banking era, and join the conversation for our next deep dive. Remember, the ground might feel perfectly still right now, but that doesn't mean you shouldn't check your foundation.